Hey everyone, me Kevin here. I'm not drinking coffee. Instead, we're going to talk about betas. Maybe we'll touch on alphas, but mostly we're going to talk about betas in this video, which is really exciting because of something that Cathie Wood said about betas and Bitcoin. Now, in order to understand what Cathie Wood said regarding betas and Bitcoin, it's helpful to understand betas a little bit. So let's do a quick little primer on betas and show you something really interesting. And while I show you, you'll actually learn the magic of what Cathie Wood said regarding Bitcoin. It's actually something that gives you a reason to, well, I'll let you know regarding Bitcoin. All right, let's hit it up. So here we go, okay? We're gonna jump over to this chart, which obviously isn't showing right now because I didn't plug the iPad in. It's helpful before you start recording a video like this to plug your devices in. But anyway, while that comes up, I may as well say that you could still take advantage of that 38% off coupon code linked down below to join me in the programs on learning how to make YouTube videos without technical difficulties, building your wealth through stocks, real estate, property management, or sales, and a whole host of other things. Take a look at the courses linked down below. That coupon does expire tonight. All right, folks, so here we go. So let's imagine you created a portfolio that had 6 stocks in it. So you've got Tesla, Bitcoin, Walmart, Peloton, Neo, and Etsy. Okay, and you had $100 in each of them, so equal weight. That would be a total portfolio of $600. So far, so good, pretty easy. Now, here's something interesting. Here's something that says adjusted beta NASDAQ. All right, so this gets a little tricky, so let's try to make this as simple as possible. We'll just go down here to the white screen, we'll say this. The stock market, in this case, let's say the NASDAQ, oftentimes people use the S&P 500 for this, but in this case, we're gonna use the NASDAQ. So let's say the NASDAQ has an increase in stock price of, say, 10%. Well, if you have a stock that has a beta of 1, so a beta of 1, your stock should go up 10%. If you have a stock that has a beta of 1.5, your stock should go up 15%. In other words, you're multiplying by whatever the beta is. Beta of 2, 20%. Beta of 0.5, 5%. See, beta is really just anchoring usual returns to whatever an index does. And so think about it this way. If you're looking at the NASDAQ on a chart over time, and over time, the NASDAQ is kind of doing this over time, well, this right here is the beta of 1. That's what the market is doing. But let's say you have a stock that has a beta of 2. Well, just amplify this whole thing by 2. This is generally what your beta looks like this. Now, what's cool is some stocks also get something called alpha. And alpha is if you end up getting something that looks like this, where the stock actually went up above what the amplification of the beta was. So I know that that can be a little tricky, and this will make more sense when we hit some numbers, and we're gonna see a really sweet conclusion regarding Bitcoin. We don't have to worry so much about alpha though right now, we're gonna stick to beta. Basically what we did here is we said, look, beta equals 1, stock market, okay, consistent path, got it. Beta equals 2, twice the up and down swings. So when the NASDAQ goes up 10%, Tesla, for example, is going up 20%. But when the NASDAQ, see the reverse works too, when the NASDAQ's going down 10%, Tesla's going down 20%. And sometimes this gets amplified in both directions by other extremes. When you have net returns above beta, we call that alpha. That's why there is a website called Seeking Alpha. So anyway, again, if we have a negative over here, if we say negative 10% on the NASDAQ, then you could expect something with a beta of 1 to be at 10%. Beta of 1.5 to be at negative 15%, and so on. So how do you figure out what this beta is? Well, you could do math for it, or you could cheat and you could use websites that tell you. Like, here's Yahoo Finance that tells you the 5-year monthly average beta for Tesla is 2.06. But in the example, we use 2, fine. Now, usually, if it doesn't tell you what index this is based on, they usually use the S&P 500 because you're comparing to an index. All right, so now take a look at this. What I did is I listed the adjusted betas for the following stocks from their correlation to the NASDAQ and the S&P 500. Now, adjusted beta is just a way of trying to estimate a little bit into the future. It's oftentimes pretty close to the normal beta, but if some of these numbers look different from numbers or betas that you're looking up, that could be why. But anyway, we're not going to go into detail on that. So for right now, let's focus on the adjusted beta here for the NASDAQ. All right, so Tesla's at 1.77. So in other words, if the NASDAQ went up 10%, we would expect Tesla to go up 17.7%. If it went up 27.7% over an extended period of time, then we could say that extra 10% is the alpha at Tesla. All right, anyway, let's focus here. So Bitcoin is actually under 1 compared to the NASDAQ. We're going to talk about Bitcoin in just a moment. That's 0.905. Then we've got Walmart at 0.4. Then we've got Peloton at 0.854. We've got NIO at 1.88 and Etsy at 1.61. And if I average these together, I get an average portfolio of about 1.24. That's my beta weight here. So for every $100 increase in the NASDAQ, I would expect my portfolio to go up about $123. And if I compare to the S&P 500, the same portfolio, S&P 500 goes up approximately $100, then I would expect my beta weighted to the S&P 500 portfolio to go up about $110.93. And that's because the S&P 500 and NASDAQ, they don't trade the same, right? Okay, good. So now we're going to do something really interesting. Let's go ahead and get rid of the drawings, and we're going to manipulate this a little bit. So what I want to do is I want to say, you know what? I want to increase my beta. When people say they want to increase their beta, it usually means they want to increase their risk. So watch what Bitcoin can do here. First thing what I'm going to do is I'm going to jump in here to the editor. I'm going to take out Walmart. Walmart has very low beta. So we're going to pull out Walmart. And immediately you could see if the NASDAQ goes up $100, instead of making $123, all of a sudden I'm making $140 on my portfolio by taking out Walmart. Walmart in this case is kind of like an anchor. It's kind of holding me back when the indices are going up. But when things are going down, Walmart helps soften the blow. So if I want less volatility, I want more stability in my portfolio, I would want more stocks like Walmart. I would want low beta stocks in my portfolio to help dampen some of those fluctuations. If I want higher returns, heck, you know what? Let's get rid of, in that case, Peloton. And this is higher returns above the NASDAQ, right? Not necessarily guaranteed higher returns in general. And you have more risk with high beta stocks too, right? More of a chance of BK, really. But anyway, if I got rid of Walmart and Peloton, I would actually have a portfolio that would go up, or should go up, $154 when, this is within certain standard deviations, every time the NASDAQ goes up $100. If I go over here and I take out, we take out, let's see, Walmart. Oh, we already got it out here. Do we? No, hold on. There we go. We take out Walmart and Peloton. There we go. And the S&P 500 goes up $100. I would make about $131. Obviously, if you invest into an S&P 500 index fund, if you invest $100 and it goes up 10%, you'd expect to make $10. Anyway, here's the cool thing. So one thing, and this is where Cathie comes in, and she says, okay, let's say you have a really high beta portfolio. So you've got Tesla, some Bitcoin, NIO, and Etsy. That's all you have. NIO, Etsy, and I mean that's pretty concentrated, right? Anyway, you've got NIO, Etsy, Bitcoin, and Tesla. You've got $100 in each. Pretty concentrated. You're going to have some crazy swings. So the NASDAQ goes up $100, you're making $154. That's awesome, unless of course it's going down, because if the NASDAQ goes down $100, you're going down $154 with it, right? So let's say you wanted to introduce some beta or some beta averaging to your portfolio, where you said, you know what? I can't handle those kind of crazy fluctuations. I still want to be exposed to Tesla. I still want to be exposed to Etsy and NIO, though, that have these really high betas. Well, Cathie suggests, hey, you can invest in Bitcoin to help beta weight your portfolio, because in her opinion, when you compare, the way she did her numbers, when you compare Bitcoin to the S&P 500, and with her beta calculation, she got it down to close to around a third, or so a beta of around 0.33. That's pretty close to real estate, she says. In other words, very uncorrelated to the market. Now, my adjusted beta comparing Bitcoin to the S&P 500 is about 0.54, but if I compare it to the Dow, which maybe is what Cathie was doing, you get pretty dang close to 0.3 when you compare Bitcoin to the Dow. But I want to compare Bitcoin to the NASDAQ in my beta-weighted portfolio here. Now, because we're going to change one of the investment amounts, that is, they're not all going to be equally weighted here, we're going to actually look at this right here, which is the beta per investment. So we're going to go ahead and drop in $300 per Bitcoin. So we've got $300 in our portfolio in Bitcoin, $100 in Tesla, $100 in NEO, $100 in Etsy. And what you can see is all of a sudden, the beta on our portfolio actually went down. We were at basically 1.54, which is relatively high beta. It's large swings, right? All the way down to 1.33. And we could make this more and more extreme by adding Bitcoin, which is really incredible. Now, it becomes a lot more noticeable when you add it over here at on the S&P side, because look at this. On the S&P, you would have a beta of 0.54, but by adding a bunch of Bitcoin, you can actually lower your beta substantially. That's fascinating, because that means you could lower the insane ups and downs of your portfolio by adding Bitcoin. Look at just how much when we compare betas. In other words, look at this. Your S&P weighted portfolio ordinarily would swing about 1.32 times for every dollar that the S&P swung. You put in that Bitcoin, it might actually only swing 1.06, which is much less of a swing, but you've actually invested into the assets maybe that you want to invest in, while at the same time weighting your portfolio for less insane up and down swings. Now, why is that frickin' amazing? Well, Cathie Wood suggested that, hey, if people can beta weight their portfolios with Bitcoin because it has a low correlation to the market, then that means firms could have more predictable returns, lower likelihoods of margin calls, and lower likelihoods of massive fluctuations that lead to massive pain or massive euphoria, both which could lead to irrational decision making. This argument, by the way, brilliant, in my opinion. Brilliant argument. If you found this kind of perspective helpful, consider checking out my amazing programs linked down below, and I look forward to seeing you there. Thanks so much for watching, and we'll see you in the next one.